And good morning. Welcome to Breakfast Club on June 1st, another Monday in the books, and the bubble talk has come back. I'm going to take you through a number of things today. Our AI2 open positions portfolio is approaching a 100% return since February. But I also want to go back in time to September of last year when I ran the first AI2 summit and take a look at some of the stocks that I recommended and why I recommended them and their performance since September of last year, as well as the IBL 2026 portfolio of 6 stocks that I gave out, wrapped around a major point, which is related to an article that was posted at Yahoo Finance this weekend, which really irritated me because it sends the wrong message to investors today. And that message was about stock splits and the need for stocks to split so that retail investors can buy them. And they're sending the wrong message. And I'll show you why. I'll show you how I think. You don't have to think the way I think, but you'll understand, I think, better my approach to investing. Doesn't mean my way is better. I mean, although 100% return in 5 months is better than the S&P is doing, but I get it. People want to buy stocks that are low priced, but there's a cost to that. And we'll briefly explore that today. I also want to talk about IPOs. And we had an IPO last week, and I guess it's Cerebras or Cerebras. Pronounce it however you like. Sounds like one of those drugs that you see promoted in, the late night TV shows. Although I don't know what that one fixes. But at any rate, we'll talk about what the IPO mania from 1999 and how that actually contributed to the dot-com crash, and how that's not the same thing that's happening today. And again, all of this wrapped around, here comes the bubble talk and why they're wrong at the moment. And then I'll also share with you a number of things that are upcoming for the summer months, and then get you on your way with your trading days. So off we go. The AI2 portfolio still outperforming our open portfolio positions right now, 99.5% as we open today's trading. AMD with superior return in the last month and a half. Stock has more than doubled since the beginning of April. Micron and Max Linear continue to be the 2 largest performers, well over 300% in both cases. And actually, I have two different Micron positions. I have a second position in my dad's portfolio, which is also up over 120%. And that's an example where I bought late. So you see the top one, we bought at 226. That's a 300% return. The second one bought at 438, still 100% return. So can't stress enough. Don't be afraid of stocks at higher prices. You know how many shares we bought at that 438? 5. That's it. Just 5 shares. So that's a profitable position. And at the end of the day, that's all that matters. My dad's IRA, which is essentially my inheritance portfolio, currently up 67% on open positions. And we're doing well. And in fact, I just spent this weekend revamping the math behind the methodology to create cleaner math. And I'm really excited about it because the biggest issue that I've been having, which is similar to what many people are complaining about right now, stocks are at high prices. So how do you choose a high-priced stock and ensure that you're buying a company, even though it's high priced, at the right point in time, where it can still appreciate in value in weeks, days, months forward? And the math that I worked out over the weekend is going to help me to do that for the AI2 portfolio. Going back to September of last year during the AI2 summit, I made a number of recommendations from small caps to mid-large caps, to momentum stocks, to long-term stocks. And I want to take a look at 5 names. Micron, Applied Optoelectronics, Amprius, IonQ, and Symbiotic. And the the underlying argument as we started to move into this realm of artificial intelligence was, one, looking for companies that had a unique position. They had strong earnings growth projected. It's projected, not predicted, and that they sat at a unique place within the artificial intelligence chain, whether it was supply, whether it was the supply chain, or a powered industry, things of that nature, the different segments that I walked through. And these five stocks had unique stories. Micron, still a big story. Their HBM3 memory, high bandwidth memory, their HBM3 chip at that point in time in September was already sold out. And as we've moved into 2026, their memory is sold out for 2026, 2027, into 2028. This continues to underscore the problem that the bubble talk people, which is demand is outpacing supply. And it is not only hyperscaler demand. Later today in the AI2 session at noon, we're going to talk briefly about the difference between cloud inference and edge inference, and why I want to be ahead on the edge inference side, because that's the next major move inside of artificial intelligence. I just gave it away, but there it is. But if you don't know what edge inference is or what it means, then you can't build a book of stocks that have the potential to benefit from that next shift from cloud to edge. Cloud is where we are right now. Edge is where we're already there, but we'll be more there, or there at some point in the next 6 to 12, or over the next 6 to 12 months. So as with everything, I'm always early. I'm trying to stay ahead of the game. I think I've done that fairly well. And I don't mean that to pat myself on the back. It's just that everything taking place, all of the things taking place inside of artificial intelligence are moving at a pace that is difficult to keep up with if you're an individual investor, which is why I use artificial intelligence to keep up with the trends that are taking place and the news that takes place inside of artificial intelligence. No irony there. Applied Optoelectronics is in the optical space, along with companies like Lumentum, Coherent, Ciena, all companies that we've held. All three of those are companies which we have held inside the AI2 portfolio. Applied Optoelectronics has had a significant rise in share price. Next up, Amprius, a stock that we currently hold in the AI2 portfolio and in my dad's portfolio. They're a battery. Essentially, they're a battery-powered company, but they are selling across a number of industries, and the newer industries include artificial intelligence and space and drone technology, and in the future, quantum computing. All of these are growth areas for the company in the future, which is one reason why we added it. IonQ is quantum computing. That is long-term speculative. And IonQ, I think, hit a high earlier in the 70s, fell off heavily with all of the quantum stocks, and then they've all since, in at least last week, the announcement that the administration would essentially be providing grant money or free money, also known as taxpayer dollars, to quantum computing companies and drone technology companies via the Pentagon, by taking stakes in these companies, similar to what the Trump administration did with Intel. Personally, I'm not a fan of this, but it is what it is. We play the hand that we're dealt. That resulted in a pretty rapid move up for a wide swath of quantum computing companies last week, between the week before and last week. Rigetti, Qubit, IonQ, all with pretty big moves last week. And then the last company I gave you last year was Symbiotic. And the one thing that I said about Symbiotic, the one issue with the company, was that they were largely single client focused. That client is Walmart. Symbiotic is building out an autonomous warehouse, which has the potential to be, I should say, uh, a huge benefit to a company like Walmart or companies like Target, Costco, and others, where you're central, or you're attempting to centralize a massive amount of product and then be able to redistribute that product to more localized, your more local stores. And Symbiotic it's been a streaky stock. It's been up, it's been down. In fact, the performance across the board on those recommendations, Micron, since I shared it at the AI2 Summit, up over 470%. AAOI also up over 400%. Amprius is currently up over 70%. And IonQ is basically flat. So again, quantum is the future. It's the Star Trek version of artificial intelligence. So I've always felt that quantum is way too early. There's a difference between being early and being way too early, and quantum still feels way too early, too speculative. Most of those companies not printing positive earnings yet. They are shipping product, and that puts them on the path toward profitability, but they just are not there yet. And finally, Symbiotic is down 18% versus September of last year. And I think it had a high somewhere in the 70s. I didn't check the chart, but I know it was up for a period of time and then it's been down. But again, if they can prove that they can add clients or add new customers, that's a stock that still has potential for long-term growth. If they stay single stock focused, meaning a single client focused, meaning they're dependent upon Walmart, I would walk back that recommendation and say I don't think that that's a company that really has a long-term growth path. But that remains to be seen. That's why we keep up with all of the news. And that means for some of these stocks like Amprius, I still see this stock having significant growth potential. Current estimated targets right now are running anywhere between 40 to 45 to $50 a share. Stock is trading right now around 20. It has garnered significant institutional accumulation in the last 2 months and has a ramp to long-term growth. IonQ, again, still speculative. Symbiotic, also to a degree, still speculative. IonQ, I would say, obviously has a much better ramp than Symbiotic, but still, I think worth keeping an eye on both of those companies. If Symbiotic pulls back again to the 40s, I'm sorry, with Symbiotic in the 40s, maybe that's an add point and trade it for a 10 or 20% move and then walk away. See if it pulls back again. IonQ, same thing. You can count on quantum to momentum run, pull back, momentum run, pull back. That's consistent. They went through a very extensive downtrend from Q1 into Q2 before everything took off in April. So be aware of that. These are stocks in the quantum realm that are susceptible to long-term or longer-term sell-offs. So I would continue to warn against that. On the Yahoo Finance side, this was the headline: AI stocks shutting out retail. Yeah, they are in a sense. But the writer of this was Brian Sazi, and the issue here is one of his viewers wrote in, a woman named Dorothy, wrote in to say, the market is shutting out Main Street, dozens of the top names trading north of $500 or $1,000. Why aren't there splits? Well, there are good reasons for there not being splits. But the issue that I had with the article was that the writer actually proposed that stock splits are necessary and needed right now, right this very minute. And the problem is that splits don't create value. Splits have nothing at all to do with the fundamentals of the company. The reality for investors is price is not the problem, it's a capital problem, right? People don't have a lot of money to spend. Why don't they have a lot of money to spend? Oh, I don't know. Inflation, gas prices, uh, 3.5 to 4 years of increasing pressure on the middle class to meet basic costs. Uh, those could all be contributing factors. But the reality is, if you can't afford one share of a $900 stock, that's a financial issue. That's a money issue. It's not a stock price issue. And the a good example here is Priceline. Priceline just split last month, 25 for 1. First time that the company has ever split stocks, has ever had a stock split, ever in its history. And that was a stock that was trading at one time, I think it was trading at nearly $5,000 a share. But it had a long run in the $3,000s, $4,000 per share range. So unless you owned an index fund, a mutual fund, or an ETF which held Priceline, most retail investors never own shares. Now they've split, and I mean, the stock is what, 20 something dollars a share, so maybe, but that stock still had a massive run for investors who were able to buy it at any point in time. Even if you bought it at $1,500 a share, by the time the stock split, you still had a 3x return. So one share of Micron still validates the point. We'll take a look at that on the next one, on the next slide here. But the quality of the company is more important than the stock price. And I get everybody wants to own 100 shares, or they want to be heavily in on stocks when they're $10 or $20 or $50. Well, it's not always possible. Number one, and number two, it's not always the best bet. Micron, even at $900 right now, $971, has forward targets now that have been raised to $1,700 to $2,000 a share. SanDisk, trading at $1,600, had its price targets raised to $3,200. SanDisk is the new Priceline in that respect. It's a stock that it just keeps going up and up and up and up. Well, if you buy it at $1,600 a share, even if you buy one share and it moves to $3,200, that's a $1,600 gain or a 100% return on one stock, versus trying to chase names that are cheap without respect, without any fundamental basis for actually owning the stock. Why would I own SanDisk? Because it has a massive backload of orders for their flash memory. They're in a significant growth upcycle. The stock is trading at 9 times forward earnings. 9. Micron is trading at 8 times forward earnings. So why would I own these stocks? Because they're deeply undervalued against the backdrop of the demand cycle that is taking place in the memory chip and storage area. Same reason I would own Lumentum even at $800 or $900 a share. A generational shift in demand at the optical level. Ciena, ADI, Coherent, all stocks that we've owned. AMD is now cycling up rapidly. And against this whole backdrop of the bubble, demand outpacing supply is a time problem. And number one, meaning most of these companies have, and this is true for Corning, Ciena, Coherent, Lumentum, Micron, to a degree, SanDisk, Seagate Technologies, Western Digital. All of these companies are faced with the same problems, and they're not the only ones. They're just the fastest ones I can name for you here. They can't keep up with demand, which means demand is being pushed out into 2027 or even 2028, which means this build out of the internet is going to continue to accelerate. In fact, hyperscalers, Google, Amazon, Meta, Microsoft, have all increased to a small degree this year their expected outlay for capital expenditures to build out data centers. And a little hint here, data centers equal cloud inference. There's an entirely new structure coming for edge inference, and that structure affects semiconductors, memory, storage, optical, servers, computers, mobile phones, tablets, etc. So the biggest issue that these people keep coming, the financial media keeps coming out with this bubble talk crap, is this is not a singular event. This is a multiplicative, multiple year event that is taking place. And at the moment, it doesn't have an end. And it's happening at the business end. It is still a business transformation, not the consumer end. And that is another major difference in the internet comparison. The 1999 dot-com crash was a, in a sense, a consumer crash. Right? Consumers didn't really buy stuff at that point in time. This is a business transformation. Businesses are investing in and adopting artificial intelligence faster than expected, rolling it out faster than expected, versus the internet, which was simply a massive build out of connectivity. It's nothing else, followed by early stage websites, early stage e-commerce, early stage digital communication. This is so the comps are not the same. That's the other issue, I guess, that really bothers me here. In fact, we'll take a look at a couple of things on that here in just one more slide. And again, continuing, even on the small portfolio side of things, the representative example here, but the 6 stocks that I gave away during the Investors Blueprint Live event this year in March, 6 total stocks: Advanced Micro Devices, Vicor Corp, Talent Energy, Teradyne, RadNet, and Kratos Defense. Those 6 stocks. Somebody with just $10,000 or $11,000 could have owned all 6 of them, even though most of these stocks were trading anywhere from $70 to $300 per share. So you don't have to be a millionaire to be able to participate even at small levels and generate significant returns, because these 6 stocks, since the middle of March, at the middle of March when we held the IBL event, they're up 50% in just over 60 days. 50%. That's a $5,400 return on 6 stocks in 60 days. Benefit? They benefited from the massive recovery, the huge V-shaped recovery in April and May, certainly. We also were able to buy them at lower prices for most of them, but they all still have forward stories. AMD, number 2 supplier for GPUs, CPUs to NVIDIA. Teradyne starting to expand its customer base. They were another one of those companies with limited customers, and that was holding back their revenue growth. The stock is still in the 300s. It's still ownable even at that level. The stock fell following its most recent earnings report. Why? Customer concentration was the key factor identified as improving their fundamentals and their growth and their revenue in the rest of this year and next year. RadNet, RadNet in the healthcare industry, speculative, long term. If you have, the stock's down 10% since March. If you have time, that's nothing. In fact, it's less than $100 loss. Same with Kratos, is about less than $200 loss for one of the best drone defense companies, and that they've moved up a little bit following the Pentagon's announcement that they would consider taking stakes in drone technology companies. But they're also waiting on the passage of $1.4 trillion defense budget bill, something along those lines. Early stage, right? Give these stocks time. I tell you what, every one of them has come back. There's no shortage of me kicking myself for decisions I've made in the last 6 months that where I sold the stock, fundamental reason, whatever my fundamental reason, earnings, debt, cash flow, didn't like the setup in the company, and I was wrong. Astera Labs, great example. Bought in, we were up, stock fell after earnings, went as low as $100? I think $100 or $110 a share. Now it's over $300 a share. didn't have the patience to wait out an earnings blip, earnings miss. These things are going to happen with these companies right now, but it doesn't mean that they're in a bubble. So even with 2 stocks that were in the red, this portfolio of just 6 stocks, even at a small capitalization, is still outperformed the S&P 500 in 2 months. So that's how fast these stocks are being repriced. One of the core things I shared last year was the methodology that I use, focusing on forward earnings growth rates, uncovers stocks that need to be repriced by Wall Street. They're undervalued today relative to earnings tomorrow. Tomorrow could be next year, 2 years from now, 3 years from now. And what happens in those cases where those companies are meeting or beating those earnings expectations is Wall Street is pulling forward future pricing to get ahead of those future earnings. That's what we're seeing happen with Micron. That's why Micron has moved from $200 to $900 a share. It's certainly happening with SanDisk, which has moved from $50 a share last year to $1,600 a share today. These repricing events happen over a long period of time, but they happen faster than most retail investors can react to them. By the time you hear it on CNBC or in whatever your favorite financial publishing newsletter is, or Jim Cramer, the stock has already moved. I mean, case in point, we bought Micron twice last year, October and again in November in the AI2 portfolio. At the end of the year last year, Motley Fool, Porter Stansberry, Agora, all of the major competitors that are like thousands times bigger than us, what was their number one stock for 2027? Yep, Micron. CNBC, Jim Cramer just came out 2 weeks ago with a big thing on Micron. Y'all are late. That's all I have to say about that. But again, the process uncovered why Micron was undervalued at that point in time. And it has proven itself correct because of Micron's operational excellence, because of the demand for memory, because they, as the number 2 memory supplier, they are holding their position against Samsung, which Samsung has a strike starting tomorrow. So Samsung's going to fall behind. The final nail here for the bubble people is to understand this. The 1999-2000 dot-com collapse, I'll call it the bubble and then the crash, I guess, was one of the major causes, IPO mania. There were over 450 IPOs in 1999 alone, 450. And of those IPOs, the majority of them had almost 100% returns on their first day. So Rebus just did something very similar, nearly similar, 68% on its first day. But retail investors, and one of the other factors here was the 1997 to 1999 period experienced some of the fastest growth in online trading access and accessibility for retail investors. So with that came the ability to get in on an IPO on the IPO day, the day it went live in the market. And that fueled hundreds of millions of dollars in retail investments in IPOs. That was more cause or causation to the bubble, coupled with everything from companies that had no revenue, no earnings to speak of, fraudulent companies, MCI Worldwide, Global Crossing, Enron, et cetera. Right? But the fact that people just blindly threw money at companies without understanding the fundamental value, that led to the bubble more than anything else. Second, splits were also a symptom. They weren't a cause, but they were a symptom behind that. You had companies that would split multiple times in the same year, same fiscal or calendar year. That was unsustainable and unrealistic. So one of the things that I see happening right now is a lot of these high-priced stocks are not going to split. If SanDisk were going to split, they would already have announced it by now. I think. I'm sure they could certainly do that at some point in the near future. But um, one of the things that I think is happening is that the companies that are having their stock prices pushed this high are less likely to split right now, in part because they don't want day trader interference creating unnecessary volatility in their stock price, because their stock price in many instances is tied to um, intra artificial intelligence deals. Right? NVIDIA invests in Lumentum and gets warrants for share ownership in return. Well, and neither NVIDIA nor Lumentum want those warrants to be worth less than the value at the time of the deal. So the stock isn't going to split because they'd have to go back and rewrite the agreement, et cetera. But I'm sure they've already accounted for that. But what they also don't want is extreme volatility in these stocks right now. Same thing on the lending side. If they're taking out debt deals, they need stability in their stock price and their market cap to justify the levels of debt that they may be taking on. So there are a number of factors here that I think are actually driving the no split uh, territory that we currently find ourselves in. So, but the argument that these stocks have to split in order for retail investors to be able to participate is just wrong at its core. It's the wrong message to send to retail investors. That's why I don't like Yahoo. I think, frankly, that author should retract and rethink where he stands on that. So, sorry, this is going to be a little longer of a Breakfast Club, but I think it was worth it to cover all of that. Breakfast Club will be offline until September. I may do a couple of special events during the summer, but I'm not going to be on a set schedule. That is due to some major renovations that we are making in Traders Reserve, which will be announced next Monday at noon Eastern here in the Breakfast Club channel or on Zoom. But some major changes that I'm making over the summer. So I will be back after Labor Day with Breakfast Club. But again, I may backfill a couple of special sessions, one or two each month, but I'll announce them as we go. For AI2 members, we'll be talking about the Options Desk pilot a little bit later today during the noon session. And for everybody else, the next AI2 virtual summit, this will be similar to last September's, but it'll be sort of like a Summit 2.0, because now it will be 10 months, coming up on 10 months since I held the first summit. And now what I can show you is everything that has changed in artificial intelligence from last September to today, and how the universe of stocks is changing. And it's changing rapidly. So there are actually more investment ideas and opportunities related to artificial intelligence than most people think. And some of those are more reasonably priced. So there are still opportunities out there. You need to know how to find them, how to value them correctly, and how to have a good reason to own the stock other than, I heard somebody talk about it, like me. So I'm going to hold that in July. That'll be after the 4th of July. So when we get to 4th of July weekend, I'll announce the next summit date at that point in time. So thanks for joining me today. We have Millionaires Trading Club at 10:30 today, and AI2 Insiders Briefing is at noon Eastern today. A reminder that is a time change for today. So noon Eastern for AI2 Insiders. And for everybody else, have a great trading day. Have a great trading week. And I will see you again in another webinar very soon.